It's easy to feel overwhelmed by the many complexities that often come with dividend investing, but it doesn't always have to be complicated. In fact, it can be a straightforward and very rewarding strategy if you could ignore a lot of the noise and know where to focus your efforts, which is why I put together these 10 commandments that, if followed diligently, will put you on the right path towards creating cash flow and reaching financial freedom, which is what we're all about here on the channel. But anyway, getting into the first commandment, thou shalt not chase yield. Look guys, I know it's tempting to buy those high 30% yielders, but this is like playing with fire. And there's a couple reasons why a stock might have a high yield in the first place, both of which indicate an increased amount of risk for you as the investor. First off, a high dividend yield can be a reflection of a company's declining share price. When share prices go down, that dividend yield goes straight up, even though the actual dividend payout per share remains the same. And in this instance, you need to figure out why the stock is declining in share price, and there could be a myriad of reasons. Either way, investing in stocks solely based on their high yields without considering what's under the hood could lead to bigger problems and bigger losses than you'd rather deal with. Secondly, a high dividend yield could indicate an unsustainable dividend policy. However, this isn't always the case, as some types of investments like business development companies and real estate investment trusts have to pay out a high percentage of their income to shareholders, so they have high yields by design. But still, you need to look under the hood to ensure that the stock or the fund that you're investing in has the capability to sustain those high dividend payouts, or else you're going to get burned. Anyway, the second commandment, thou shalt always reinvest dividends, which is one of the most crucial commandments. It makes the biggest difference for your portfolio and allows you to capitalize on the immense power of compounding. You see, when you get a dividend and that dividend is reinvested to go purchase more shares, this in turn creates even more dividends, more than you had before. And if you repeat this process over and over for a long period of time, it creates what we refer to as the dividend snowball effect, which is what causes the exponential dividend income growth over time. As an example, let's say you start investing $100 every single week for 20 years into SCHD. And I know guys, we always use SCHD as the example. It's just such a good go-to. But anyway, with dividends reinvested, after those 20 years, you'd be bringing in just under $17,000 of annual dividend income, and your portfolio would be valued at about $372,000. Now compare this to if you didn't reinvest dividends, your income would be a lot lower, only about $11,000, so about $6,000 less annual dividend income if you don't reinvest dividends. And furthermore, your portfolio value drops by about $134,000 to $238,286. So as you can see, reinvesting dividends makes a world of difference, which is why it is a commandment that you must follow. And now moving on to the third commandment, honor thy tax implications. Understanding how dividends are taxed and knowing how to avoid paying them is crucial for maximizing your returns, especially across a long period of time. Here in the United States, dividends are subject to different tax rates, and at a very basic level, it's broken down into two categories. You've got qualified dividends, which come from companies like Procter & Gamble or Coca-Cola, which are subject to long-term capital gains tax rates and are typically lower than ordinary income tax rates. And as of this year, the maximum tax rate on qualified dividends is 20% for those who are in the highest tax bracket, which is in contrast to non-qualified dividends, or ordinary dividends, another name that they go by, where you can be taxed up to 37% depending on your level of income. Ordinary dividends come from real estate investment trusts and business development companies, which is why many investors prefer to hold them in a tax advantage account like a Roth IRA. But anyway, moving on to the fourth commandment, thou shalt learn from thy mistakes. And this obviously doesn't just apply to investing, this is true for life in general. But with that said, wrong moves and misjudgments are bound to happen with investing, especially considering it's something you'll probably be doing for 20 or 30 or possibly even 40 years. I've already made tons of mistakes and have gotten many things wrong in the 3 short years that I've been a dividend investor, and I think this is in part because I started doing this with zero experience. I don't have a background with this stuff, and I most certainly didn't go to school to learn about finance, but I think it's something that we could all stand to learn more about because it is so important. And on that note, I want to talk to you about today's video sponsor, Southern New Hampshire University. Now, as someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said I'd never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value. You'll learn to apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio. You'll learn to utilize the rules and regulations for financial accounting and reporting in a global economy. You'll learn to generate financial records and financial statements for users in accordance with governing rules and regulations. positions, and you'll learn how to analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on a call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryne or find the link in the description to see what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryne. Anyway, getting back on the topic of making mistakes, one way to minimize the negative impact of your misjudgments is found in the 5th commandment: thou shalt diversify thy portfolio. It's pretty simple. Basically, just don't put all your eggs in one basket and make sure to spread your investments across different companies and different sectors and industries so you reduce risk and avoid being overexposed to any one single holding. Now, how much diversification is enough is kind of hard to pinpoint, and it's going to vary from investor to investor. I know some people who have less than 10 stocks in their portfolio. I know others who have upwards of 50, even closer to 100, and I personally have around 20 different holdings in my main portfolio. And if the thought of even figuring out how many stocks you need to have in your portfolio is stressing you out, then you may be better off going the ETF route and just investing in a fund like SCHD or VU, or even both, which would give you automatic exposure to hundreds of different companies. Anyway, moving on to the 6th commandment: honor thy payout ratio. And the payout ratio, in case you haven't heard of it, measures the percentage of a company's earnings that they're paying out in dividends. Now, in general, a high payout ratio suggests that a significant portion of a company's earnings is being distributed as a dividend, which leaves less money to be reinvested back into the business, which could potentially result in slower growth for the company in the future. However, it can be a little bit more nuanced than that. Certain industries with stable cash flows may have higher payout ratios, while growth-oriented industries may have lower payout ratios as they reinvest more in their operations. And there's a lot more we could say about a payout ratio, but as a general rule of thumb, to keep it simple, something less than 60% is preferable. But like we mentioned, that doesn't mean that a payout ratio above that is necessarily cause for concern. The payout ratio is just one piece of the big picture. And now moving on to the 7th commandment: thou shalt not forget about risk, which kind of combines the 1st, the 5th, and the 6th commandment all into one. All of these things, like the dividend yield, the payout ratio, how well diversified your portfolio is, these are all factors we can use to determine how much risk you're exposed to. By taking into consideration all of these necessary factors and really looking at the big picture, you can mitigate your risk of investing in a company that might cut their dividend or possibly, unfortunately, even go bankrupt. And if this does happen and your portfolio is well diversified, then you wouldn't be as negatively impacted because you weren't overexposed to that one bad egg. And now moving on to the 8th commandment: thou shalt not panic sell. Now remember, guys, the stock market is a strange and unpredictable creature. Your holdings will go up and they will go down, sometimes for reasons that don't make any sense whatsoever. But with that said, if the market does take a downturn, whatever you do, don't panic sell.
Don't do it.
The good thing about investing in dividend stocks is they're typically a bit more stable than other types of stocks. And as long as there's nothing fundamentally wrong with the company and the dividend is still intact, then you're good. In fact, it could be even better because remember, when that share price goes down, that dividend yield goes up, which means if you were to buy more shares at a discount, you'd be able to get a better cash flow return than you otherwise would have been able to. Overall though, just stay the course, okay? Don't panic sell and you'll be rewarded in the long run. And this is a perfect segue to the 9th commandment: thou shalt have faith. Guys, dividend investing is a proven strategy for building wealth over time. If you believe in your investment strategy and if you believe in the long-term success of the companies you're invested in, then you'll be more likely to stick to the plan through thick and thin. One thing that really helps me when I start to feel like my portfolio isn't growing fast enough, or if I feel like I'm not bringing in enough dividend income, is to watch videos from people like Kevin Burgess or Gen X Dividend Investor, who are both retired and living off of passive income. I know that sometimes it feels like things move at a snail's pace along this dividend investing journey. Sometimes it does. When you first start out, things really do move pretty slow. But watching and learning from guys like Kevin or Gen X really motivates me to keep going, and it shows me what my portfolio could look like down the road if I just keep investing and have faith that it will pay off. And this brings me to the 10th and final commandment, which is probably one of the most important, and it's also one of the hardest: thou shalt be patient. Once again, guys, I get it. It's tough, but dividend investing is a long-term strategy, and you build your portfolio brick by brick. For many of us, it will take decades to build a portfolio portfolio that will generate enough income to really reach financial freedom. But you have to get started and you have to be patient, and you will be rewarded. And having said that, once you do actually start investing, that dividend snowball gets going pretty fast. I've only been investing for about 3 years now, and I've made more money than I ever thought I would in this short amount of time, which I'm telling you all about in this next video right over here. In this video, I'm gonna share with you exactly how much money I've made with dividend investing these last 3 years, and I'll also show you what my dividend income is gonna look like a couple of decades down the road as I continue to invest and reinvest those dividends. So click right over here to check it out, and I'll see you in the next one.